They collect millions in rent and pay zero in taxes. How is that even legal? In 2023, the average American household paid around $14,800 in federal income tax. But across the country, thousands of real estate investors who collected millions in rental income paid nothing. Legally, zero. And they didn't hide their money offshore or exploit some gray area loophole. They used a provision that's been built into the tax code since 1913. It's called depreciation. The IRS says that buildings wear out over time, like a car loses value the moment you drive it off the lot. And they let you deduct that wear and tear from your taxable income year after year, even if the property is actually going up in value. It's the single most powerful legal tax strategy in America. And in this video, we're going to show you exactly how it works. Here's the core idea. The IRS assumes that every building in America is slowly falling apart. A residential rental property, according to the tax code, has a useful life of 27.5 years. A commercial building, 39 years. After that, the IRS considers it worthless, at least on paper. And every single year of that lifespan, the owner gets to deduct a portion of the building's value from their taxable income. This is called a depreciation deduction. It's not money you spent. It's not a repair bill or a mortgage payment. It's a phantom expense, a paper loss that exists only on your tax return. And that's what makes it so powerful. You're collecting real rental income every month, but on paper, your building is slowly dying. That paper loss offsets your real income, and in many cases, it can wipe out your entire tax bill. The IRS isn't being generous here. They designed this to encourage people to invest in housing. But the result is one of the most effective tax shelters ever created. Let's run the numbers. Say you buy a rental property for $1 million. The IRS doesn't let you depreciate the land, only the building. So if the land is worth $200,000, the depreciable basis is $800,000. Divide that by 27.5 years, and your annual depreciation deduction is $29,090. Now let's say your rental income after expenses is $50,000 a year. Subtract the $29,090 depreciation deduction, and your taxable income drops to just $20,910. At a 24% tax bracket, you'd owe about $5,018 instead of $12,000. That's a tax cut of nearly 60%, and you didn't spend $1 to get it. But here's where it gets really interesting. If you own multiple properties, those depreciation deductions stack. 2 properties means $58,180 in deductions. 3 means $87,270. At a certain point, your paper losses exceed your real income. And when that happens, your taxable income from real estate drops to zero. Quick tip, the land to building ratio matters. A $1 million property where 80% is building gives you $29,090 per year. But if only 60% is building, your deduction drops to $21,818. Always negotiate the allocation with your accountant. Now, $29,090 a year is nice. But what if you could claim 5 or even 10 times that amount in year 1? That's where cost segregation comes in. Normally, the entire building depreciates on the same 27.5-year schedule. But a cost segregation study breaks the property into individual components and assigns each one a shorter depreciation timeline. Appliances, carpeting, and cabinetry, 5 years. Landscaping, fencing, and parking lots, 15 years. Plumbing, electrical wiring, and specialized flooring, 7 years. Instead of spreading $800,000 over 27.5 years, a cost seg study might reclassify $300,000 worth of components into these faster categories. That means you could deduct $60,000 or more in the first year, instead of just $29,090. A typical cost segregation study costs between $5,000 and $15,000, depending on the property. But for a $1 million building, the first-year tax savings alone can be $20,000 to $40,000. It pays for itself immediately. Quick tip, cost segregation works best on properties worth $500,000 or more. Below that, the study cost often outweighs the benefit, and you need a qualified engineer, not just an accountant, to perform the analysis. The IRS takes these studies seriously. Cost segregation is powerful on its own, but when you combine it with bonus depreciation, the numbers become extraordinary. Under the Tax Cuts and Jobs Act of 2017, investors could claim 100% bonus depreciation on qualifying property components in the very first year. That means every dollar reclassified through a cost seg study into 5, 7, or 15-year categories could be deducted immediately, all at once, in year one. On a $1 million property, that could mean deducting $250,000 to $350,000 in a single year. If your total income is $300,000, a deduction that large could reduce your taxable income to nearly zero. Now here's the catch. Bonus depreciation is phasing down. In 2023, it was 80%. In 2024, 60%. In 2025, 40%. And in 2026, it drops to just 20%. By 2027, it's gone entirely, unless Congress extends it. This phase down is why real estate investors have been accelerating their purchases. The window for massive first-year deductions is closing. Quick tip: bonus depreciation applies to new and used property, as long as it's new to you. So a 30-year-old apartment building you just purchased still qualifies. That's a change from the pre-2017 rules, which limited bonus depreciation to brand new assets. So depreciation wipes out your taxes while you own the property. But what happens when you sell? This is where most people think the tax bill finally comes due. When you sell a depreciated property, the IRS charges depreciation recapture tax at 25% on all the depreciation you've claimed, plus capital gains tax on any profit. On a property where you've claimed $200,000 in depreciation and the value has risen by $300,000, that's a combined tax hit of $110,000 or more, unless you use the 1031 exchange. Section 1031 of the Internal Revenue Code lets you defer all of that tax, the capital gains, and the depreciation recapture by reinvesting the proceeds into another like-kind property within 180 days. You sell a $1 million duplex, buy a $1.5 million apartment building, and the IRS treats it as if no sale ever happened. Your tax basis carries over. Your depreciation clock resets on the new property, and you owe nothing. The most disciplined investors have chained 1031 exchanges for 20 or 30 years, building real estate empires worth tens of millions, without ever paying capital gains or recapture tax. Quick tip: the 1031 exchange has strict rules. You must identify your replacement property within 45 days and close within 180 days. A qualified intermediary must hold the proceeds. If you touch the money, even for a day, the exchange is disqualified and the full tax bill comes due. Now let's put the entire strategy together, step by step. Step 1. You purchase a $1 million rental property. Step 2. You hire an engineer to perform a cost segregation study, reclassifying $300,000 of building components into accelerated depreciation categories. Step 3. You claim bonus depreciation on those reclassified components, generating up to $180,000 in first-year deductions. That alone could eliminate your entire tax bill. Step 4. For the remaining years, you continue claiming standard depreciation of $18,180 annually on the remaining $500,000. Your rental income is offset, reducing your taxable income to near zero. Step 5. When you're ready to sell, you execute a 1031 exchange into a larger property. Your tax basis carries over, depreciation resets, and you owe nothing. Step 6. You take out a cash-out refinance on the new property. Loan proceeds are not taxable income. You access hundreds of thousands of dollars in equity, tax-free. This is the cycle that allows real estate investors to collect income, build wealth, and extract cash, all while their tax return shows zero or near zero income. It's depreciation plus leverage plus the 1031 exchange. Together, they form the most powerful legal tax strategy in the United States. Before you rush out and buy a rental property, there are real risks you need to understand. First, depreciation recapture. If you ever sell without a 1031 exchange, the IRS will claw back every dollar of depreciation you've claimed and tax it at 25%. On a property where you've deducted $200,000 over 7 years, that's a $50,000 tax bill on top of capital gains. Second, the passive activity rules. The IRS classifies rental income as passive, which means your depreciation losses can only offset other passive income, not your W-2 salary. There's a small exception. If your adjusted gross income is under $100,000, you can deduct up to $25,000 in rental losses against active income. That phases out completely at $150,000. The only way around this is to qualify as a real estate professional, which requires spending 750 hours per year and more than half your working time in real estate activities. Third, bonus depreciation is disappearing. By 2027, this turbocharged strategy may no longer exist. And finally, the IRS does audit cost segregation studies. If your engineer cuts corners or overclassifies components, you could face penalties and interest. Quick tip: always work with a CPA who specializes in real estate. General accountants often miss thousands of dollars in legal deductions because they don't understand these strategies. So why does the government allow this? Depreciation isn't a glitch. It's a deliberate policy choice. The reasoning goes like this: America needs housing. Building and maintaining rental properties is expensive and risky. Without tax incentives, fewer investors would take on that risk, and the housing supply would shrink. Depreciation is the carrot that keeps private capital flowing into real estate, and the numbers back it up. The National Association of Realtors estimates that real estate accounts for roughly 17% of U.S. GDP, or about $4.5 trillion per year. It supports over 9 million jobs. The tax code's generous treatment of property isn't an accident. It's an engine. But critics argue the system disproportionately benefits the wealthy. A family earning $80,000 a year can't easily access cost segregation studies or 1,031 exchanges. Meanwhile, investors with $10 million in property may pay a lower effective tax rate than a schoolteacher. Whether that's fair is a political question, but the strategy itself is completely, unambiguously legal, and it has been for over a century. Would you ever use depreciation to reduce your tax bill? Or does the complexity make it not worth it? Drop your take in the comments. And if you want to understand the full playbook that billionaires use to avoid taxes, watch our breakdown of buy, borrow, die, the strategy that started it all.